Hello everyone, today's topic is going to be options. So basically an option contract is between two parties and it gives the buyer the right to buy, which is a call option, or sell, which is a put option, an underlying asset. So what this means is an underlying asset is basically what the contract refers to. So in every options contract, there has to be a specified asset that gives the buyer the right to buy or sell, and that's what the underlying asset is going to be. But usually, the underlying asset is going to be a specific stock. So the option buyer has the right to buy or sell the asset, while the option seller has an obligation to sell or buy that asset. So when the buyer buys the contract, they have the right to buy or sell. So they have the choice basically. And then when the seller sells that contract to the buyer, they don't have the choice anymore because the buyer has the choice, at which point that's why the seller has the obligation. And to make up for this, that's why there is a premium involved. And the premium of the options contract is going to just be the price of the option. So whenever you see premium for options, you can just think that's going to be the price. So that's the buyer pays the premium and the seller receives it. And this premium, so the price, is going to be determined by the strike price, the expiry, and volatility. So basically what these are is first the strike price. This is going to be the price at which the option can be exercised. So whether it be for calls or puts, it's going to be a little bit different, but the strike price is going to be for calls if the stock price goes above the strike price, that's when the buyer can exercise a call option. And for the strike price for put options, if the stock price goes below the strike price for any put option, then the buyer of the contract can exercise that for put options. And then for expiry, that's just going to be the expiration date. So every contract will have an expiration date. The farther out it is, the more premium you have to pay to buy a contract. But the expiry is always just going to be the expiration date. And then the volatility is just going to be how volatile the stock is. So basically how much it fluctuates day to day. So if a stock is $10 and it usually stays around $10, that would have low volatility. And then if it moves up and down quite a bit throughout the day or week or whatever time period you're looking at, that's going to have a high volatility. And one thing to keep in mind with options contracts is when they are talking about for stock options, one contract is always going to be equal to 100 shares of whatever stock it is. So if the premium is listed as, let's say, 4 cents, you have to multiply that by 100 because of the 100 shares. So it would actually be $4 in that situation. So some can be as cheap as 4 cents per share, or some can be maybe like $1 or $2 per share, which would be a couple $100s for the whole contract. So based on these main parameters here of strike price, expiry, and volatility of the stock, the premium can change drastically. And then I just wanted to touch on the two types of options. So we have call options and put options. Those are just the two types that currently exist. And to get to call options, this just gives the buyer the right to buy the underlying asset at a specific price before the expiration date. And then the put option is just the opposite, in which case it gives the buyer the right to sell the underlying asset at a specific price before the expiration date. So that's the difference between them. Call options, just remember that it gives the right to buy, and put options gives the right to sell. So this is just a brief overview. I really want to make some more videos specifically on call options and put options. Maybe go over some strategies with both of these as well. But yeah, this was just a quick rundown of options in general. And if you have any questions, let me know.